All right. Here's the next series of how to start Bitcoin and cryptocurrency investing. The quickest and easiest way to get into crypto investing with little to no money. So in the previous video, I talked about generating a yield. I'll put a link to the previous video up if you didn't see it in the comments or at the bottom in the description. And some people had some questions about how do I generate passive income or a yield or dividends from cryptocurrency investing. So there's a theme around a lot of people where they want to hold US dollars instead of holding Ethereum or Bitcoin. They want to hold US dollars in crypto. Now, there is no benefit to that other than the stability. So when the market is going down, you might want to hold US dollars. The way I see it is I want a portion of my portfolio to be in dollars, and then I want the rest to be in cryptocurrency because I believe currency will go up and dollars will go down in this environment. So what I do is I take a portion of my portfolio, I put it in US dollars, and I try to generate interest or yield on a monthly basis. So I'm going to talk about that. So in the outline, how I structure my portfolio, how I generate yield on spare cash, and the future of decentralized finance. All right, so step one, I'm just going to give an overview of my portfolio and the structure of the portfolio. So these are my guidelines. So roughly 90% of the portfolio is going to be invested in cryptocurrency coins. So I'm going to also go deeper into that. So I might have 10 positions so that if one coin goes to zero, I still have the other 9 coins. So 90% of the portfolio is invested in cryptocurrency coins. And I mostly go for small caps. 10% of the treasury is going to be in US dollars, earning a yield. And then I rebalance the total portfolio monthly or quarterly. So trading. So this would be for the individual positions. So I have some guidelines. You must take out your original investment when you have a 3x profit. So if you put $1,000 into a coin and it triples, I will take the original 1,000 out right away. That way I'm doing things methodically and not emotionally, because sometimes you'll say, oh, it's up so fast, let it ride. Then it goes back down and you're like, oh man, I wish I would have taken some profits. So I just put this rule in to make things automatic, take the emotions out of it, stop you from making crazy mistakes. But then you also want to let that coin ride because it might 100x. And you wouldn't want to sell everything and then the coin goes up 100x. And you've done all that research on that one coin and the team and the history and the investors. And all of a sudden you don't get to enjoy the profits because you took profits too early. So B, let winners ride. I just talked about that. The way you let your winners ride is by de-risking your portfolio as soon as possible. When taking profits, 30% of your profits can go into a treasury, which is the cash reserve, and then the other 70% can go back into investing in new coins and new currencies or new ideas. And then I distribute the remainder of the profits into new coins. So there you go. So here's an example of a coin that actually went up like crazy this week. So it's called Chills, and it has to do with NFTs and collecting coins related to sports teams. So FC Barcelona is participating in this coin and like 10 other big companies. So this is going to be $1,000 investment example. So you purchased $1,000 worth of Chills on 8 March 2021, which would get you 6,666 coins at 15 cents a coin. So you've now converted your US dollars into this coin because you believe it's going to go up. On 8 March, the price is 15 cents, worth $1,000. On 12 March, the price triples to 47 cents. So now you have $3,133. So at that point, you start thinking, well, is it going higher? Is it going to $1? Is it going to $2? You're looking on Twitter, you're looking on Reddit, your friends are telling you something crazy. It's hard to make these decisions. You usually get crippled by analysis. So what I'll do, I'll just say, you know what? I hit the rule. I'm taking $1,000 out. So to take $1,000 out, you have to take out 2,127 coins. So now you've sold that 2,100 and you have your $1,000 cash, but you still have 4,539 coins remaining. So you have 1,000 in cash, 2,000 in coins. Later that day, on 12 March, the price balloons to 87 cents. So now you're up almost $4,000. So because it's doubled, you can make another rule where I'm going to take another $1,000 out. So now you have $2,000 in cash, right? And you still have almost $3,000 left in the coin. So with that $2,000 that you've cashed out, what you're going to do is you're going to put $600 in the treasury, which is just US dollars, and the $1,400 you can look for another coin, maybe another coin that you think is just as good or the future of finance, and then you can reinvest in that, and you have $1,400 to reinvest. At this point, you're still holding the Chills tokens worth $2,900, and if it goes up 100x, right? If it goes up 10x, you're looking at $29,000. If it goes up 100x, you're looking at $290,000. But if it goes to zero, you've already doubled your original investment, which is great. So on 14 March, the price drops to 67 cents, and now you're grateful. So you can either, you can buy the dip, or you can just ignore it, and you can just keep holding those coins for a year, 2 years, 3 years, or whenever you want to sell. So now I'm going to just do a visual of that. So you started with the $1,000 invested at the top, and your original investment triples in value. So now it's $3,000. You take some profits, which is $1,000 US dollars. So now you have $1,000 US dollars in profits, and you have 2,000 still invested, and you want to let your winners ride. So now the price rises the same day, and that investment grows to 3,900. You still have the 1,000 in cash. So then you're going to take another 1,000 in profit. So now you have 2,000 in cash and 2,900 still invested. Like I said, you let your winners ride. So at this point, you have secured 100% gain on your original investment, with the opportunity for the remaining profits to increase over time, risk-free. So if this portion here of 2,900 goes to zero, it doesn't matter, because you've taken $1,000 original and turned it into 2,000. So now you move on. So what are you going to do with that 2,000 in cash, right? So what I would do is I would move it to a Treasury Fund. So the Treasury Fund is my static passive income. I'm trying to build myself a pension, or build myself a way to pay my whole mortgage, or your rent, or pay for a car. So you're going to move this money into a treasury, and you're going to start earning interest on that money. Then you're going to take the other capital and you can reinvest it and try to find another winner that might triple, quadruple, 10x, 100x. So this is the chart of the Chills coin, where on 8 March you bought at 15 cents. Right by the 12th of March, it hit 45 cents. Then it keeps going up. You're glad you didn't sell everything. And then it goes down, and you continue from there. So at that point, right, you're taking profits as it rises. Now it could shoot up even higher, and you could just keep taking a little bit of profits as it keeps going up. So that is a really methodical way to take the guesswork out of it, and you'll be less emotional because you won't be making mistakes. You're doing everything at the same time. So now what's a treasury fund, right? So the Treasury Fund is a cash reserve that provides a stable, predictable income with limited exposure to volatility of crypto. Crypto is very volatile and it's very risky. You can see profits go from $1 million to $100,000 in days, right? So it's good to have a Treasury Fund and a cash fund that is delinked from the risk, right? So my Treasury is always a cash fund, and I'm going to show you where to get a yield. So what kind of yield can $600 that we put away generate in a year? So currently, in March 2021, there are platforms that will pay you up to 25 to 30% annual interest on a US dollar-based coin, not even a risky coin like Ethereum or Bitcoin, but 25% annual on a US dollar coin, which ends up being $12.50 a month. So you have just added a month, which is maybe your Netflix bill, is now free because you invested $600. So if you had a zero, what kind of income could a $6,000 investment generate? $6,000 could be $125 a month. So now that is maybe your electrical bill is paid for by your cash treasury. And then we have last but not least, what would a $60,000 cash reserve Treasury Fund generate? It would be $1,250 a month. So as your portfolio goes up and you keep depositing into your treasury, your passive income grows. And then, we have one more example, which is what kind of income could a $600,000, not $60,000, $600,000 position generate? And that would be $12,500 a month. So your goal is to compound your crypto over time, but also be safe and take some profits so that if it all goes to zero, at least you have your US dollar coin, right? So now, where do you get these returns? Where do you find these 25% returns or 12% returns or 6% returns? This is called yield farming or market making. So because crypto is decentralized, you don't have big banks and investment funds that can just back all of your trades and leverage them. So the people that are using the crypto have to be the ones that are funding these decentralized exchanges. By putting your coins in the exchange, you become an owner of all of the fees that are generated on these exchanges. So yield farming would be you putting up money or crypto inside of an exchange like Coinbase, like Uniswap, like 10-inch exchange or 1-inch exchange. So you want to put your crypto inside of one of these ecosystems, and you want to provide liquidity, and they give you a share of the profits. Why do you want yield? Because the point of investing in general is to have income for life. It's not to get rich. It's not to get whatever. If you have income for life, you can live and do whatever you want. So it would be better to make $12,000 a month forever than to have $1 million and you buy a restaurant or you buy a bar and the bar goes to nothing, right? With that $12,000 a month, you can live a life where you can predict what you want to do, where you want to be, where you want to live, where you want to travel. So it's the point of this is to have income for life. What is the standard rate of return in 2021? So the standard rate of return in 2021 would be around 6%. And then there are new platforms that encourage you to join them by paying a higher percentage. So you can get up to 30% is what I've seen. And where to find these pools. So let's go take a look at it. Then we'll talk about the future of DeFi. So let me go back to my window. Okay, so we're going to go on the first exchange. This exchange is called Huobi. So what Huobi does is they have a bunch of cryptos that they will generate yield on and they will pay you. So instead of the USDC, they have called the HUSD. So they have USD Tether. They're paying 6%. That's pretty standard. And they have the Huobi USD, 6%. And then they have the USD Tether. If you put it in for 90 days, they'll give you 8%. Then you have what's called structured earnings, where they will give you more investment choices, and you can go from 7% to 235% annual in a 30-day period. And then if you click more, they will tell you what the yields are and what the products are. So these are all Bitcoin related products. It looks like, 34% per year, expires on the 25th. You need at least, that's the index price. So that's Huobi, right? They give you some options. Now we're going to go on Uniswap, which is the largest decentralized exchange in crypto right now, which means there's no owners and the people, it's like a co-op, the people are the owners. So Uniswap has a bunch of token pairs where you can earn between 2% and 500% per year. So if you look at the liquidity fees like USDC and ETH, they're doing 29% per year, all the way up to, Whale and Earn versus ETH, 432% per year. So that is a second place where you can go and get yield. Now you have to do research on every one of them because they all have positives and negatives. Now Binance, when you're going on the Binance exchange, they also have returns that they will generate. So let's see what we can do here. See if we can get an example. So on the Binance US dollar, let's say I had 100 US dollars. Oh no, this is not the liquidity. There we go. Okay, so on the Binance US dollar BNB pair, you're going to look at, say, 1,000. And they're going to tell you that the yield is 7.5% on the Binance coin. Wait, USDC, USDT. So Binance is the third option, and actually they have the yields here. So BNB 15%, stable coins. So their stable coins they're doing is 10%, 10%, 10%. So that's an option. Binance. And the last one, is there one more? No, there's two more. Okay, so USDC on KeeperDAO. So KeeperDAO is another decentralized yield farm, and KeeperDAO is doing 29% on just a US dollar coin. So you can hold the US dollar coin and get 29%. There's $41 million locked up in this exchange. So you would just click on there and then you would deposit, and then you would start earning yield. So this is a good place to get a yield. And then you have Rari Capital. So Rari Capital, on their stable pool, they're doing 11%. They're doing 10% on their yield pool, and then on Ethereum, they're doing 10%. So this is way better than regular finance where you're getting less than 1%. These exchanges are doing 29.52%. So the way it works is when you're an early adopter, they pay you a high rate, and as more money comes in, the rate goes down. So on average, you might be looking at 6% to 12% per year. And then there's other centralized places like Coinbase and all the others. So almost everywhere is going to offer you this yield, but that's the point. So you're going from the Treasury. You're going from the Treasury, and what you want to do is you want to make sure that you have cash generating income, and you want to continue. And you want to continue to invest. So that's the tools. The future of DeFi. So the future of DeFi is going to be the following four things so far, but there'll be way more things in the future. So the way I see it right now, staking, the problem with staking, which is putting coins up for the actual coin. For example, Ethereum. To participate in staking, which is going to replace physical mining, you need 32 Ethereum. The price of Ethereum is around, let's say, $2,000 a coin right now. I think it's $1,800, but we'll round it off to 2,000, right? So 32, you need 64,000 US dollars. That is not a retail investor amount of money to be staking. So what's going to happen is there's going to be delegated staking where you put your coins inside of a wallet, or you put your coins inside of a contract, and someone else will do the staking with your coins the same way the pools happen. And you'll be able to delegate your portion of the coins to them, and then they will pay you out. So the yield for Ethereum for staking is around 7% right now, but it could go up or down depending on the demand. So the second thing that's going to be is the yield inside of your wallet. So you won't even have to do anything. You won't even have to go to any of these sites. You will just go in your wallet and click stake, And there are wallets that have this already. You'll click stake and they'll give you interest directly in your wallet, and they'll pay you, by the second, by the minute, by the hour, and it'll be very simple. But right now it's a little bit hard because we're just not there yet. It's early. Number 3, staking inside of your wallet. So the difference between yield would be interest on your coins, where staking would be generating more coins of that altcoin. So you're taking more of a risk because you believe in the coin. And then the 4th thing in DeFi is cheap gas. So right now, every transaction you do costs you $40 to $60. So you don't want to do very many transactions when you have a small account. But eventually, Ethereum says, they've been saying this for a while, that the gas is going to be cheaper and the transactions are going to be faster. So we'll see. So that wraps it up. So if we go back to the beginning, right? So how I structure the portfolio, just a quick review. So the portfolio is 90% in the coins, 10% in the treasury. Then I have set times when I deposit to my treasury. Then I take that treasury, I generate cash returns or a yield, right? Generating income. And then I'm waiting for the future of DeFi, where it's going to make these things more simple. So this is how you decentralize your finances. And I hope you enjoyed the presentation. If you have any questions, just comment below. I might do a follow-up video on some of the questions, or I'll just respond right in the comment. You can follow me at SAMGSK on Instagram or Twitter, because that's where I post the most about crypto. And just stay tuned, like and subscribe the video. And yeah, stay tuned for more future videos where I'm going to break down how to decentralize your finances and invest in crypto and Bitcoin with little to no money even further. Thank you.